Most people think financial failure looks loud. A crash, a headline, a number on a screen going to zero. But the truth is, the most dangerous financial failures are quiet. They happen while everything still looks fine. While your 401k statement keeps going up. While your retirement calculator tells you you're on track. And that's the uncomfortable question I want to start with. What if you can do everything right? Follow every rule, invest consistently, avoid stupid risks, and still end up short? Not because you made a mistake, but because the world your plan was built for no longer exists. What if the number you're counting on isn't lying, but the measuring stick is? That's what this video is about. Not a market crash, not a recession, and not panic. It's about something far more subtle and far more important. A shift happening underneath the financial system itself, slowly enough that most people won't react until it's too late. Because when the rules of money change, they don't send you a notification. They let you keep playing until the outcome no longer makes sense. And by the time you notice, years of compounding decisions are already locked in. To understand why this matters, we need to zoom out for a moment, not to theory, not to predictions, just to what actually happened. In March of 2020, the Federal Reserve created roughly $4 trillion in about 8 weeks. That wasn't a policy debate. It was an emergency response. In 2021, Congress sent stimulus checks to millions of people who never lost their jobs. Again, not ideology, damage control. In 2022, Russia was cut off from the SWIFT payment system after invading Ukraine, something that had never been done to a major economy at that scale. In 2023, China and Brazil began settling oil trades in their own currencies instead of the US dollar. No speeches, no announcements, just a quiet change in behavior. In 2024, central banks bought more gold than at any point since the mid-20,000th century. And now, in early 2026, the yield on the 10-year US Treasury is higher than it was at the peak of the inflation crisis. Each of these events, on its own, can be explained away. A crisis response, a geopolitical outlier, a temporary adjustment. But when you line them up, they stop looking random. They start looking like a pattern. And patterns matter more than headlines, because systems don't break all at once. They drift, they stretch, they absorb pressure quietly, until one day, the assumptions everyone relies on no longer hold. And the people who notice last are usually the ones who trusted the system the most. Most people hear everything you just heard and immediately think the same thing. Okay, so we're heading into another recession. Maybe a bad one. Layoffs, tighter credit, the usual cycle. But that framing misses the point entirely. A recession is a reset inside a stable system. Demand falls, companies cut costs, prices cool, the Federal Reserve steps in, and eventually the cycle turns. We've been through that playbook dozens of times. What we're dealing with now is different. This isn't a slowdown inside the rules. It's pressure on the rules themselves. A recession assumes the measuring stick stays the same. The dollar holds its role. Bonds behave like bonds. Inflation eventually goes back to something normal. But what happens when those assumptions stop being reliable? You can't model the future if the framework you're modeling on is changing underneath you. That's the distinction most people miss. They're still preparing for a storm when what's happening is a gradual shift in climate. And the danger of climate shifts isn't the first bad season. It's building your entire life around weather patterns that no longer exist. If your financial plan only works under one specific set of monetary conditions, it's not a plan, it's a bet. And right now, a lot of people don't realize what they're actually betting on. The easiest way to understand the global financial system isn't through charts or balance sheets. It's through a simple metaphor. Think of the post-World War II monetary order like a massive commercial lease. After the war, most of the world was economically destroyed, and the United States was the landlord with the only building left standing. The deal was straightforward. The U.S. dollar would become the global reserve currency. Countries would trade oil, goods, and debt in dollars. In return, the United States would maintain a stable currency, keep inflation relatively low, and provide military and political security to keep global trade routes open. For decades, that lease worked. The U.S. had the largest economy, the strongest military, and a deep financial system the rest of the world trusted. Trust was the real collateral. And as long as that trust held, the system functioned smoothly. But here's what happens with long leases. Over time, the landlord starts taking liberties. Maintenance gets deferred, rent goes up, rules get bent, and eventually, the tenants start looking at other options, not because they want to move, but because staying starts to feel riskier than leaving. That's where we are now. The dollar system didn't break overnight. It aged, it stretched, it accumulated compromises. And most people inside the system never noticed because it still worked well enough on the surface. The danger isn't that the lease ends suddenly, it's that it quietly stops being worth renewing. And once that thought enters the tenants' minds, the system begins to change in ways that are slow, structural, and very hard to reverse. The first real crack in that lease showed up long before most people realized it. In 1971, the United States closed the gold window, ending the dollar's direct link to gold. From that moment on, the dollar was no longer backed by a physical constraint. It was backed by credibility. For a long time, that worked. The US economy was dominant, manufacturing was strong, the population was young, and global demand for dollars kept growing. Trust filled the gap where gold used to be. But trust is a psychological asset, and psychological assets erode when they're stretched too far. Fast forward to today. U.S. national debt has crossed $36 trillion, roughly 120% of GDP. To put that into human terms, imagine earning $60,000 a year while carrying $72,000 in credit card debt. You're not insolvent yet, but you're living on borrowed time. And yes, the U.S. has carried high debt before. After World War II, debt to GDP was over 100%, but the context mattered. Back then, the U.S. was a net creditor, not a net borrower. It had a manufacturing base and favorable demographics. Today, the situation is reversed. The country borrows to service interest on debt it already owes. That's not a temporary imbalance. That's a structural dependency. And when lenders start to sense that a borrower can only survive by rolling debt forward indefinitely, trust quietly turns into skepticism. Not all at once, not publicly, but just enough to change behavior. And in financial systems, behavior matters more than intent. This is where the conversation stops being purely financial and starts becoming human. Because monetary systems don't fail in spreadsheets, they fail in societies. One of the clearest warning signals Ray Dalio points to in every historical cycle is internal order versus disorder, and the driver of that shift is usually inequality. In 2024, the top 1% of Americans controlled roughly 32% of total wealth, while the bottom 50% held about 2%. That gap is wider than it was in 1929. Inequality by itself doesn't break a system, but it changes how people relate to it. When a large portion of the population feels permanently priced out of progress, trust erodes. Institutions feel distant. Long-term promises start to sound hollow. And here's the part most people miss. Political instability isn't the cause of financial stress. It's the symptom. Investors don't panic because of protests or elections. They panic because instability introduces uncertainty into long-term obligations. If you're worried a government may change the rules, inflate away debt, or struggle to maintain internal cohesion, you don't want to lend that government money for 10 years at a fixed rate. You shorten timelines. You seek assets that don't rely on political promises. This is how confidence quietly exits a system without ever announcing itself. No alarms, no collapse. Just a slow shift in preferences that compounds over time. And when that shift reaches a critical mass, the effects ripple outward, far beyond domestic politics, into the behavior of nations themselves. If you want to understand where a monetary system is heading, you don't listen to speeches. You watch balance sheets. Central banks are some of the most conservative institutions on the planet. They move slowly, they avoid drama, and they don't chase trends. That's why what they've been doing over the last few years matters so much. In 2024, central banks collectively bought more than 1,000 metric tons of gold, one of the largest purchases on record. China, Russia, India, Turkey, very different political systems, very different strategic interests, all making the same move. They weren't buying gold because they expected a crisis tomorrow. They were buying it because gold doesn't carry counterparty risk. It doesn't depend on another country's policy decisions, political stability, or willingness to honor obligations. When institutions that think in decades start favoring assets that sit outside the dollar system, that's not a statement, it's a hedge. And hedges tell you what people are worried about, even when they refuse to say it out loud. This isn't about abandoning the dollar overnight. It's about reducing exposure to a single point of failure. Because when a system has worked for a long time, the biggest risk isn't volatility, it's complacency. Central banks aren't predicting the end of the dollar. They're preparing for a world where it matters less. And once that preparation becomes widespread, it begins to reshape incentives across global trade, finance, and geopolitics in ways that are very difficult to unwind. Every reserve currency in history eventually faces the same temptation. If the world depends on your money, you can use that dependence as leverage. For decades, the US dollar benefited from being the neutral plumbing of global trade. But neutrality erodes when access becomes conditional. In 2022, Russia was cut off from the SWIFT system, the global messaging network that enables cross-border bank transfers. The intention was clear: isolate, punish, deter. But the outcome was more complicated. Instead of collapsing, Russia rerouted trade. Energy deals with China were settled in yuan and rubles. India began buying Russian oil using rupees. China and Brazil expanded bilateral trade without touching the dollar. This wasn't defiance, it was adaptation. When a system can be turned off with a policy decision, participants start designing alternatives not because they want to challenge the system, but because they don't want to be vulnerable to it. And once alternatives exist, they don't stay limited to bad actors. They spread through caution. This is the same psychology that drives a bank run. A bank doesn't fail because it's insolvent. It fails because people believe it might be. That belief changes behavior, and behavior creates reality. Weaponizing money teaches the world how to operate without it. And even if those alternatives are clunky at first, they improve over time. Because incentives are powerful teachers. Once enough participants start using parallel systems, the dominance of the original system doesn't collapse. It thins. And thinning is enough to change the math for anyone relying on the old rules. Abstract systems are easy to ignore until they touch something personal. So let's make this concrete. Meet David. He's 42 years old. He earns about $110,000 a year, has $350,000 in his 401k, and like most people his age, it's invested in a target date fund. He contributes 6% of his salary, his employer matches 3%, and according to every retirement calculator he's ever used, he's doing everything right. Those calculators tell him that by age 65, he'll have roughly $1.8 million. On paper, that sounds like success. But that number is built on assumptions most people never question. It assumes long-term stock returns average around 7%. It assumes inflation settles back near 2.5%. And it assumes that $1 David earns in 2049 will buy roughly the same basket of goods $1 buys today, adjusted modestly for inflation. Here's the problem. If we're entering a period of monetary transition, those assumptions don't bend slightly. They break. If inflation averages 5% instead of 2.5% over the next 2 decades, David's $1.8 million doesn't feel like wealth anymore. In real terms, it buys closer to what $800,000 buys today. He didn't lose money. He lost purchasing power. And the cruel part is that his account statement still looks fine. The number goes up, the system tells him he's on track, but the game changed underneath him, quietly. And by the time David realizes it, the years where compounding could have saved him are already gone. What makes this even more dangerous is what happens next. Because most retirement strategies respond to uncertainty by shifting toward bonds. As David gets older, His target date fund automatically reduces stock exposure and increases bond holdings. That's supposed to be the conservative move, the safe move. But safety depends on context. Bonds only protect you in a world where interest rates trend down over time and inflation stays contained. If the dollar's role weakens even partially, that world disappears. When global demand for US debt softens, the government has to offer higher yields to attract buyers. Higher yields mean falling bond prices. That's not theory, that's math. So David's portfolio ends up exposed on both sides. Stocks struggle because higher rates compress valuations. Bonds struggle because rising yields destroy existing bond values. The asset that was designed to stabilize his retirement becomes a source of silent erosion. And this doesn't require a dramatic crisis. It happens slowly, quarter after quarter, while statements still look orderly. This is how people lose decades of financial planning without ever feeling a single moment of panic. It's not a crash, it's a repricing. And repricings don't announce themselves. They just reset what your money is actually worth in real terms. By the time most people realize bonds aren't behaving the way they were taught, the adjustment has already happened. At this point, it's natural to ask what the system does next. Surely there's a fix. Surely policymakers see the same pressures. And they do. But seeing a problem and being able to solve it are very different things. In broad terms, the United States has two real options. The first is to address the root causes directly. Cut spending, raise taxes, slow debt growth, rebuild institutional trust. That path works on paper. It's also politically brutal. It requires accepting slower growth, lower asset prices, and years of discomfort in exchange for long-term stability. In a system driven by short election cycles, that kind of sacrifice is almost impossible to sustain. The second option is to change the rules of the game. Let inflation run hotter to erode the real value of debt. Experiment with new monetary frameworks. Float ideas like commodity-linked bonds, digital reserves, or alternative settlement systems. None of these are clean solutions. They buy time. And buying time always comes with a cost. Inflation shifts the burden quietly from borrowers to savers. Rule changes create uncertainty that markets hate. There is no painless path forward. Every choice redistributes stress somewhere else in the system. And history shows that when leaders are forced to choose between visible pain today and invisible pain spread out over decades, they almost always choose the latter. That's how transitions happen without anyone officially announcing them. This is the part people usually want to skip to. What do you actually do when the rules of the game start shifting? And the answer isn't a magic asset, a secret trade, or abandoning the system entirely. It starts with a mental shift. You stop optimizing for a single outcome and start preparing for a range of outcomes. That means diversifying beyond assets that only work when the dollar is strong and stable. Not abandoning stocks, but understanding their role. Holding real assets that don't rely on promises. And yes, for some people, maintaining a small position in asymmetric hedges, not because they're guaranteed, but because they protect against scenarios traditional models ignore. It also means shortening your time horizon on fixed income. Long-term bonds assume a future that looks a lot like the past. In a transition, flexibility matters more than yield. And finally, it means investing in things that aren't denominated in any currency at all. Skills, businesses, the ability to adapt and create value regardless of the unit of account. Those assets don't show up on a statement, but they survive every monetary regime. The hardest part of transitions isn't losing money. It's realizing that the world you plan for isn't the world you're getting. Monetary shifts aren't dramatic. They're slow. They show up as higher grocery bills, weaker bond performance, and retirement goals that quietly move out of reach. The people who navigate them best aren't the smartest. They're the ones who notice early and adjust calmly. Because when the lease ends, you don't want to be the last person still assuming the lights will stay on.